Hello everyone, welcome to today's US Open live webinar. It is Thursday, March 21st, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. This, of course, has been a hot week with a central bank bonanza, and that's what we're going to focus on. We had yesterday night the Fed keeping unchanged its rate outlook, and this was interpreted as dovish and led to new records for Wall Street and the greenback lower. Today we had the Bank of England just a little earlier not changing many things but leaning a bit dovish on the margins, we would say. And we also had the Swiss National Bank, which surprised earlier today by becoming the first major central bank to cut rates. So that is going to be, these are going to be the main themes of today's session. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We have quite a few things to cover. We're gonna start with first things first. We're gonna talk about the Fed and its impact on Wall Street, which clinches new record highs, of course, also boosted by the AI boom. Then we're gonna talk about the USD versus Japanese yen, because we already covered that on Tuesday. We also had a historic decision by the Bank of Japan. Then we're going to talk about the Swiss National Bank and how this, what this means for the chief. And we're going to finish things off with the latest policy decision, that of the Bank of England, and its impact on the cable. So in terms of the Fed, of course, if there are any questions, feel free to ask them, or if you would like to share your opinions on what we discussed with us. Now, policymakers did not change their view for 3 rate cuts this year. That was the main takeaway. They maintained the median terminal rate at 4.6 for 2024, but at the same time, they upgraded their GDP and core PCE projections while lowering the unemployment forecast. This contradiction is clearly dovish and shows higher tolerance for inflation. At the same time, Chair Powell did not offer much, but reiterated that cuts will come at some point this year, and he appeared to downplay recent sticky inflation. There is on the CPI, it's quite sticky. On the PCE front, recent indicators showed, recent readings showed sort of losing some of that cooling momentum. And he said that those persistence readings haven't really changed the overall story. And he doesn't think that strong hiring would be enough to hold off a rate cut in and of itself. Now, this sent Wall Street to new record highs. You can see that on the chart. We have the Nasdaq 100 here, the tech-heavy index. You can see how it charts new record highs, which continues to feed from the artificial intelligence, the generative artificial intelligence boom. Just this week, NVIDIA unveiled its new and more powerful Blackwell AI chips. And speaking on CNBC, CEO Jensen Huang said that this is the beginning of this AI computing ramp, which will last a few years, sparing more AI optimism. And of course, here, let's see the chart of NVIDIA. It's the daily chart. You can see that it's a bit off its recent all-time peak, but still close to it and poised for new ones. Also, overnight, we had shares of Micron Technology. We had the earnings, and we had the stock jumping overnight and in today's pre-market. It's the chart on the right, and you can see that the stock in today's pre-market, with still 4 minutes out, gains more than 15%, and it's about to open with new record highs. You can see this yellow line here is the pre-market trading. And the reason for that is that the company, the memory chip maker, posted strong quarterly results and rosy guidance, saying that it is one of the biggest beneficiaries of the AI boom. So these things together, AI optimism and dovish Fed, help the Nasdaq 100, which is on track to move closer to the 19K mark, the psychological level. On the other hand, the Fed still maintains a reserved approach on removing restraint. While on a technical level, the relative strength index, if we bring this up on the bottom of our screen, you can see that it is clearly overbought, well above the 80 mark. And as such, we could see a pullback back towards the 200 period EMA, which is located around 17,800. Daily closes below it would pose the bullish bias, but strong catalyst would be needed for that, and the downside appears well protected. You can see how the daily Ichimoku follows, as well as the February lows. Now, let's go to the US dollar versus the Japanese yen. Once again, if you have any opinions you want to share with us around these things, feel free to type them in the chat box, or if, of course, there are any questions or clarifications needed. Now, the pair here, again, we're on 4-hour chart, heads towards another profitable week after the outcome of the two central banks, the Fed and the BOJ. The Fed has no compelling reason to cut, while the Bank of Japan pledged to retain an accommodative stance despite its historic pivot, of which we already talked about extensively a couple of days back. This policy differential favors the pair, which is in firing distance of the July 1990 high at 152.2, but further gains towards the next major resistance have definitely higher degree of difficulty. The Bank of Japan did end nearly a decade of unorthodox and ultra-loose monetary setting, and it is reasonable to expect at least another rate hike this year. The Fed at the same time reaffirmed its 3-cut guidance, which pressures the greenback, as we already said, despite its conservative approach. So the favorable differential that we have seen over the past couple of years could unwind. Furthermore, yen weakness even after the BOJ pivot raises the risk of FX intervention by Japanese authorities. I would like to remind you here that they had last stepped in October of 2022 at similar levels. These here, September, October, at around similar levels was the actual FX intervention. And of course, we already got Finance Minister Suzuki saying that the government is watching currency moves with a high sense of urgency. So these factors can cap the upside and drive a pullback below the 200 period EMA at around 149. But the downside contains multiple roadblocks, as you can see, and sustained weakness. And it may be early to talk about sustained weakness below 145.88. This does not look easy at this stage. So all in all, given this slow but change in the policy dynamics could lead to a repricing lower and considerable one, but it's still too early because the BOJ did pivot, but did not exactly turn hawkish, as we have already said. And the Fed, although having strongly signaled multiple rate cuts, it is still on a conservative approach. Now let's touch a little bit on the Swiss National Bank because today it became the first major central bank to cut rates with its first cut in 9 years. You can see on the right the policy rate, and on the left you can see inflation, which has been printing in Switzerland below the 2% target for nearly a year, and the central banks updated forecasts so that it will remain well below that level for the coming years. So that's what actually enabled this move lower for interest rates. Of course, this sent the Swiss franc lower, and you can see sustained weakness does not look particularly easy, and you can see that we have the 200 period EMA that could support the pair, and then of course we also have this month lows that can also provide support. And now let's talk about the latest development in central banking. The Bank of England, which today left rates unchanged at 5.25% for fifth straight meeting. You can see that on the right chart. It did not change the language much, which continues to point to peak rates. But the vote split was actually a bit dovish because no member voted in favor of hikes against two in the prior meeting. Similar as in the prior meeting, one member opted for a cut. On the left, you can see inflation, which after some stickiness at the turn of the year, decelerated again, according to yesterday's data in February to 3.4%, which is the slowest pace in more than 2 years, strengthening the case for a pivot and lower rates by the central banks, with markets generally expecting summer cuts and around 100 basis points this year. And in fact, speaking on CNBC after the previous meeting, Mr. Bailey had not objected to this pricing. Now, you can see that today's decision actually puts some pressure on the cable and lifts the UK 100, the stock market. But on the other hand, officials don't expect inflation to reach the 2% target before 2026, despite projecting a temporary fall to that level in the second quarter of the current year. So the central bank probably has more work to do to bring inflation down, and this also makes it more likely to follow the Fed and the ECB down this road rather than lead it. Now, what this means for the GBP USD, let's go ahead and look. The pair rose yesterday due to the greenbacks weakening from the Fed, but now reverses course due to the BoE decision. Now, this means that we could see further decline towards this month's lows at 1.2599, but further losses definitely have a higher degree of difficulty. The monetary policy differential is a bit murky at this stage, but as we said, the BoE is likely to track its US counterpart in cutting rates because it has more work to do on inflation compared to the Fed. And as long as it continues to defend the 200 period EMA, immediate bias remains on the upside, and the pair could try for new higher highs, currently at 1.2894, but we're cautious around further advance. So that is it pretty much. That's pretty much it from me for today. Just to recap, the Fed yesterday did not change much, but maintained its outlook for 3 rate cuts this year, which was dovish, and markets reacted to that. The GBP today, the Bank of England today did not change much either. Maintained this peak rates bias, but did not embrace rate cuts. But the vote split was dovish, and the Swiss National Bank actually became the first major banks to cut rates. That's it from me. We will talk again next week, 10 minutes before Wall Street opens. As always, thank you for joining me.